Welcome back to FT Markets. An immediate crisis has been averted in Greece, but it's going to be a tense few months as a new deal is thrashed out. So what are the implications for the rest of the Eurozone and in particular for the credit ratings of other, particularly Southern European countries? With me to discuss this is Alastair Wilson, who's the head of sovereign ratings at Moody's. Alastair, welcome to the Financial Times. If we look at our first chart that you brought along, this is showing the credit ratings of the Eurozone countries where we are at the moment. And if we look at it, we have sort of a sea of stability, quite a contrast from a few years ago. What have been the main factors changing the landscape as far as you've been concerned?
As you say, Ralph, it is a largely stable outlook, and that reflects a balance of factors that we take into account. It reflects the many positive things that we've seen over the past couple of years, whether it's growth, whether it's debt consolidation, fiscal action by the authorities, set against, and I think this will take us on to the discussion in a second, the potential for shocks. Which counterbalances many of the positive things that we've seen.
Just before we go on to that, France is the only country on a negative outlook, which means it could be downgraded at some point in the not too distant future. But we have the possibility of some positive. Blue shows positive outlook, so you may actually be raising them. What is going to be the likelihood of this stability being changed? I mean, what are the things that worry you about? I mean, is Greece top of your list?
What are the things that worry us? I think the potential for shocks to re-emerge, of which Greece may be one source of one potent shock, is certainly something that we would try to reflect in the stable outlooks. Other concerns are to do with low inflation or the emergence of sustained deflation, very low growth, which makes it hard for governments to bring down their debt burdens. There's a balance of factors that we take into account.
And on Greece specifically, this stable outlook, does that assume that a Grexit, a Greek exit from the Eurozone will not happen? Or is it more assumption that if it does happen, because of changes since 2012, which you talked about before, the implications would not be so great?
It reflects our assumption, our central expectation that Greece will not exit. And indeed that some sort of accommodation will be reached between Greece and its creditors, which will avoid a default.
So if the negotiations go badly and Grexit comes back on the agenda or becomes a reality, we could see some significant downgrades?
Well, I think we expect, there's a huge amount of uncertainty at the moment, and we don't expect that to dissipate for some time. We know the negotiations will go on for some time and that they will be quite protracted. So I think it's too soon to start talking about the re-emergence of Grexit risk. I think it's fair to say if Greece were to exit the Eurozone, then that would demonstrate that an entity which was intended to be indivisible is in fact divisible. So I think it would be a significant event, but it's a long way off just yet.
It's significant for other Eurozone countries, obviously.
Potentially so, yes.
Let's talk about what might make that picture, the stability we've seen, look even better. What are the factors that could lead you to start upgrading? Well, Lithuania and Spain already on positive outlooks. What might make this look even better in a year's time?
Well, I think what's led us to this picture, and Spain is a good example, is we've seen the re-emergence of growth. Not very strong growth, but it's emerging. We're seeing domestic growth as well as export growth emerging.
And what we've also seen, which is shown in your second chart, is that the fragmentation, sort of breaking up of markets within the Eurozone, has improved significantly since 2012. This is your own indicator of financial fragmentation, basically showing that the monetary union has become more of a monetary union, although a bit of a pickup most recently, that's presumably Greece.
A little bit, and yes, that's Greece. This tries to look at the extent of financial and economic integration or disintegration within the euro area. And as you say, you can see the level of fragmentation at its greatest at the peak of the crisis. All of the measures that we look at, for example, capital flows, deposit rates, lending rates to households and corporates, show a significant level of reintegration over the past couple of years. The tick up is indeed its deposit flight from Greece and capital flight from Greece, which is one of the measures that we use, capital flight between countries.
And so from your point of view, we have a better functioning monetary union, which presumably helps the rating outlook for Eurozone countries.
Certainly that's one of the things that we take into account. Investors have been persuaded that the union will survive, and that's positive for sovereigns who need to refinance their maturing debts. The things that we've seen put in place, for example, the banking union, are again positive steps in the operation, the integration of the monetary union. Although it's fair to say, I think some of the problems that the crisis laid bare, the fact that this is a monetary union but not a fiscal or an economic union, those underlying problems still exist.
Okay, and how optimistic are you that we might get back to the sort of union levels of integration that we had pre-crisis?
I think, in a sense, we wouldn't expect that to happen. I mean, that reflected a certain optimism on the part of lenders, borrowers, investors, an assumption that the union was more fully integrated than, in fact, it was or is.
Alastair, thank you very much. We'll stop there. So, some progress, some greater signs of economic integration, but still significant worries about some countries, and particularly that threat of Grexit at some point, perhaps.